Nvidia, Apple, Meta, Microsoft. When you ask somebody what to invest in, these are usually always what they respond with. Heck, in the first video I ever did for this channel, I asked AI what the best stocks are to invest in, and it essentially just flooded it with tech recommendations. But what if you wanted to get away from tech stocks?
Why would I do that?
So maybe you already have too many tech stocks in your portfolio. Or maybe you don't even like tech. Or maybe you're one brave man and your name is Tim McReynolds, and you had reached out and said, hey, can you do one for non-tech stocks? Can you give me an analysis with AI? And because I'm a YouTuber that actually cares, I do that sort of thing. So if you do have a request, comment, because this is proof that I actually listen. So regardless of the reasoning, I pulled up my AI BFF and I said, hey, what's up? I'm looking for some non-tech stocks. And this is what happened. Dear AI, I'm trying to invest my money into individual stocks and I'd like to completely avoid tech stocks. What do you think are the 5 best stocks to invest in?
Great. I'd be happy to help you pick different stocks to achieve your goals. However, before I begin recommending them, I'd like to let you understand my criteria for selecting these stocks so you can approve of the strategy. Is that okay?
That's polite. Now, I was gonna go on blind to kind of see what happens, but this is definitely a better way. Now, just a quick reminder, this video is for informational purposes only, right? It is not financial advice. If you're looking for financial advice, I advise you to do your own research and talk to a professional before you make any decisions about investments.
In other words, don't this up.
Right.
And now that we got the disclosure out of the way, let's see what AI had to say.
When it comes to picking the top non-tech stocks, it's essential to have a clear set of criteria to guide your choices. Here are the 4 main things I considered. 1. Growth potential. We looked for companies with strong growth prospects, whether through expanding market share, innovative products, or strategic acquisitions. Growth potential can indicate a stock's ability to increase in value over time.
I'm amazed that AI even understands growth potential because I feel like that requires higher level reasoning. But yeah, that sounds good.
2. Market performance. We evaluated how these stocks have performed in the market recently. This includes their resilience during economic downturns and their ability to capitalize on market upswings.
An obvious part of the criteria. Continue.
3. Industry trends. Understanding the broader trends affecting an industry can help identify stocks poised for success. We considered how each company's industry is evolving and what future opportunities or challenges might arise.
Again, I am really surprised that AI can even do this because it really does require some deep analysis well beyond what I was asking.
4. Financial stability. We prioritized companies with solid financial health, as indicated by metrics like the PE ratio, PEG ratio, free cash flow, and DE ratio. These metrics help assess a company's profitability, growth, cash generation, and financial leverage.
So this makes a ton of sense that these were included. I actually created a video previously where I talked about analyzing stocks. You can see it right here, analyzing stocks and picking stocks. And these are some of the key metrics that AI had pointed out. So I completely understand why it would mention them here. All right, cool. So now that we got the criteria out of the way, well, let's actually look at the recommendations.
First is the Home Depot, which is a leading home improvement retailer offering a wide range of products and services for home renovation and construction. It has a strong presence across North America, catering to both DIY enthusiasts and professional contractors. Financial metrics, PE ratio. The price to earnings, PE ratio for the Home Depot, is around 20, indicating investor confidence in the company's profitability. PEG ratio. The PEG ratio is approximately 1.5, suggesting the stock is fairly valued when considering its growth prospects. Free cash flow. The Home Depot generates substantial free cash flow, often exceeding $10 billion annually, supporting dividends, share buybacks, and reinvestment in the business. DE ratio. With a debt-to-equity, DE ratio of about 1.0, the Home Depot maintains a balanced approach to leverage, effectively using debt without overextending. The Home Depot stands out for its financial stability and growth potential, making it a solid choice for diversifying a portfolio with a reliable non-tech stock.
So the rationale here seems pretty much spot on. The financial metrics look right around where they should be, and Home Depot is one of those companies that I think is special because in an economic downturn, people no longer want to pay contractors because it's too expensive. So what do? They go to Home Depot and they become a DIYer so that they can actually, fix or build whatever they're trying to do. So it's one of those companies that really is in a good spot either way. Definitely a good start. Let's move to the next one.
Procter & Gamble is a multinational consumer goods corporation known for its diverse range of products across segments like beauty, grooming, healthcare, fabric and home care, and baby, feminine, and family care. With globally recognized brands such as Head & Shoulders, Gillette, and Pampers, P&G is a staple in households worldwide. Financial metrics, P/E ratio. As of August 2024, Procter & Gamble's price-to-earnings ratio is 27.17. PEG ratio. The price-earnings-to-growth ratio for Procter & Gamble is 1.64, which suggests that the stock is fairly valued when considering its growth rate. Free cash flow. Procter & Gamble's free cash flow for the fiscal year ended June 30, 2024, was $16.52 billion. DE ratio. The debt-to-equity ratio for Procter & Gamble is 0.6455 as of June 2024. Procter & Gamble's strong brand portfolio, consistent financial performance, and ability to generate significant cash flow make it an attractive option for investors seeking a reliable non-tech stock with steady returns.
I feel like Procter & Gamble is one of those companies you don't even understand how massive they are until you really look at what brands they own. So check out this visual. They pretty much have a monopoly on detergent, which we all know is expensive. And they also have a lot of different dental care, supplies, and personal hygiene brands as well. Now, until I made this video, I didn't even realize how many of these brands that they owned. And a lot of these brands, a lot of the products are pretty much essentials for consumers. So I am definitely down with this recommendation. That makes sense. Let's see the next one, which I have to say is actually my favorite on the list.
Walmart is a multinational retail corporation that operates a chain of hypermarkets, discount department stores, and grocery stores. Known for its extensive network and competitive pricing, Walmart is a leader in the retail sector, serving millions of customers worldwide. Financial metrics, P/E ratio. As of August 15, 2024, Walmart's price-to-earnings ratio is 30.75. PEG ratio. Walmart's price-earnings-to-growth ratio is 2.36 as of August 19, 2024. Free cash flow. Walmart's free cash flow for the fiscal year ending January 2024 was $15.12 billion. DE ratio. Walmart's debt-to-equity ratio is 0.813. Walmart's strong market presence, consistent financial performance, and ability to generate significant cash flow make it an attractive option for investors seeking a reliable non-tech stock with steady returns.
Okay, so here's why this is my favorite one on the list. And I know that some people absolutely despise Walmart. They think it's an evil corporation and that the stores are generally low class or ghetto. And well, sometimes that generalization does kind of work. Let's be honest, right? It does sometimes. People at Walmart.com, have you ever been there? Go check that out. It's hilarious. But regardless, I absolutely love the brand. Okay, so here's why I love them. So number one, it's recession proof, right? It's one of those companies that really leads with price. And everybody knows that, so when they need to save money, they go to Walmart. Number two is that the buyers at Walmart, in other words, the people who buy from the suppliers, the people who work at Walmart, they are ruthless. They will kill suppliers over 2%, 3% margin, right? I love that because that basically means I save more money. And then lastly, my entire family, we get our groceries there every single week. And we're happy with the prices and the quality of what we get. So even if you hate shopping at Walmart and you go a little fancier, maybe you do Target or you do Whole Foods, you're really high class, right? At the end of the day, I agree with AI. This is a good one to buy. In fact, it's such a good one to buy that, as you can see from the screenshot, I actually have purchased it myself way before this video even happened. Let's move it on over to the next one.
Johnson & Johnson is a multinational corporation engaged in the research, development, manufacturing, and sale of a broad range of healthcare products. It operates in three segments: consumer health, pharmaceutical, and medical devices, making it a significant player in the healthcare industry. Financial metrics, P/E ratio. As of August 2024, Johnson & Johnson's price-to-earnings ratio is 1518. P/G ratio. According to the NASDAQ website, Johnson & Johnson's price-earnings-to-growth ratio is 2.54. This ratio is higher than 1, which may suggest that the stock is overvalued relative to its expected earnings growth. Free cash flow. For the month ending June 2024, Johnson & Johnson's free cash flow was $19.83 billion. DE ratio. Johnson & Johnson's debt-to-equity ratio is 0.813. Johnson & Johnson's diversified product portfolio, strong financial performance, and leadership in the healthcare sector make it an appealing choice for investors looking for a stable non-tech stock with growth potential.
So it turns out Johnson & Johnson is the medical equivalent of Procter & Gamble. It's basically a big conglomerate of healthcare companies that consumers use, including myself, nearly every single day. So here's a visual of the brands that are owned by Johnson & Johnson. And it's kind of shocking, some of these brands. They have Tylenol, they have Band-Aids, they have Rogaine, and they have Listerine, among others. Very well diversified in the healthcare space, which is always in demand. So another good pick there. Let's move to the next one.
The Coca-Cola Company is a global leader in the beverage industry, known for its iconic soft drinks and a diverse portfolio of non-alcoholic beverages. With a strong brand presence worldwide, Coca-Cola is a staple in both consumer and investor portfolios. Financial metrics, P/E ratio. As of August 2024, Coca-Cola's P/E ratio is 28.01. P/G ratio. According to YCharts, Coca-Cola's P/G ratio is 17.01. This high P/G ratio suggests that the stock might be overvalued relative to its expected earnings growth. Free cash flow. As of June 2024, Coca-Cola's free cash flow was $9.05 billion. DE ratio. Coca-Cola's debt-to-equity ratio is 0.813. This indicates a moderate level of debt relative to equity, suggesting financial stability and effective debt management.
So I'm just gonna call this one the Warren Buffett special. And he's called the Oracle of Omaha for a reason, you guys. And I think it'd be silly to really doubt this pick. So Coca-Cola has good numbers, it has a ton of brands, and it is really dominant in the soft drink category, which Americans are completely addicted to, let's be honest. So yeah, I think it's a really, really good pick. So thanks again to Tim McReynolds for that request. And like I had mentioned previously, right here is the top 5 stocks that AI is currently recommending. So you should definitely check that out if that sounds of interest to you. But this video is all about the 5 non-tech companies that AI recommends, and we've gone through the whole list. And honestly, I'm not surprised by what it recommended, right? All these companies have been around a long time. They're very stable. They are cash flow positive. They have money. They just have good public sentiment. It's the ones that, when you say the long-lasting brands, this is definitely a good list of them. And before you go, remember to make sure that you subscribe to the channel to unlock financial success one AI chat at a time. See you in the next one.